You've been saving money. Great. But now the big question is, where should you keep it? Under your mattress? In a savings account? Or maybe lock it in a fixed deposit? A recent global survey showed over 30% of people still store their savings in cash, even in the digital age. But that decision could cost them in the long run. In this video, we're going to break down bank versus cash versus fixed deposit, their pros, cons, and exactly how to choose the right mix for your financial goals. Welcome back to the channel that makes personal finance simple and practical. Today, we're diving deep into one of the most overlooked decisions in money management: where you park your savings. The right choice can make your money safer, more accessible, and even grow it over time. So grab a pen or open your notes app because this video could save and even earn you money. Before we compare where to store money, you must ask, what am I saving for? Because not all savings are the same. Emergency fund needs to be liquid, safe, and immediately accessible. Short-term goals, 3 to 12 months, for things like a new phone, travel, or a course. Long-term goals, 1+ year, maybe a home, car, or future education. Each goal may need a different parking spot. Let's explore them. Pros: instant access, no tech or cards needed. Useful for emergencies where online access is down. Cons: zero growth. Your money doesn't earn anything. Risk of theft, fire, or misplacement. Inflation erodes value. What 1,000 rupees can buy today won't be the same in a year. Best use: keep 5 to 10% of your emergency fund in cash at home, just in case. Example, if your emergency fund goal is 1 million rupees, keep around 5,000 rupees to 10,000 rupees in cash. Pros: highly liquid, accessible via ATM, UPI, or online. Safe, deposits are insured to a limit, depending on country. Some interest, typically 2 to 4% annually. Cons: low returns, barely beats inflation. Temptation to spend, money is too accessible. Fees, charges. Some banks may have minimum balance requirements. Note: best use: ideal for your emergency fund, short-term goals, and overflow cash. Tip: open a separate savings account just for your savings. Don't mix it with your spending account. Crows: higher interest than savings account, often 5 to 7%. Discipline saving: you can't access it easily. Safe investment with capital protection if with a reputable bank. Cons: locked in period, typically 6 months to 5 years. Penalty for early withdrawal could reduce your returns. Not ideal for emergencies, slower access. Best use: long-term savings you don't need to touch soon. Example, if you're saving for a wedding, car, or down payment in 2 years, FD might work. The answer is, don't choose just one. Balance then. Here's a simple balanced savings strategy. Purpose: where to park it. Percent recommendation: emergency cash, immediate. Physical cash at home, 5 to 10%. Emergency fund, general, high yield bank savings, 50 to 60%. Short-term goals, bank or short-term FD, 20 to 30%. Long-term savings, 1 to 2 year FD or safer options, 10 to 20%. This way, you get accessibility for emergencies, security from theft loss, better returns over time. This is not about choosing the best place, but the right place for the right purpose. Storing all savings in cash, you're losing value to inflation. Keeping all savings in a regular account leads to impulse spending. Locking emergency money in an FD defeats the purpose. Not tracking where your money is parked, you lose clarity and control. Instead, review your savings locations every 6 months and adjust based on your life situation. Now that you know where to keep your savings, it's time to reorganize your money today. Ask yourself, is my emergency money accessible? Are my long-term savings growing? If not, make the change now. If this video helped you, hit like, subscribe, and tell us in the comments. Where do you currently keep most of your savings? Up next, we're diving into budgeting systems, cash envelopes, zero-based budgeting, and how to actually stick to a plan. Don't miss it.